You ever stop and think, what actually stops a bank from taking your savings and just betting it all on the stock market? Well, for a very long time, the answer was a single, really powerful law. Today, we're going to dive into the story of the Glass-Steagall Act, a financial firewall that was literally built to protect everyday people's money. I know it sounds completely wild today, but before the 1930s, this was just how things worked. Banks weren't just a safe place to park your money. Nope, they were major players on Wall Street, using customer deposits, your money, to fund their own incredibly risky bets on stocks. And for a while during the Roaring Twenties, it probably felt like the party would never end. But of course, it did end. And when that party came to a crashing halt, the consequences were, well, they were catastrophic. So that brings us to the first part of our story, the absolute crisis that made this law so necessary. Okay, so try to imagine an era with almost no rules for the financial world. You had your commercial banks, the ones holding your family's savings, and they were completely tangled up with investment banks, the ones making these huge, high-stakes bets. There was no separation, no firewall. It was truly an age of financial chaos, and the public's money was sitting right in the eye of the storm. And then it happened. Black Tuesday, October 1929. The stock market didn't just take a dip, it completely imploded. And because the banks had gambled their depositors' money all over the market, when the market crashed, it dragged the banks right down with it. The dominoes just started to fall, one after another, after another. The fallout was just devastating. We are talking about thousands of banks failing all across the country. This wasn't some distant Wall Street problem, this was a Main Street catastrophe. Millions of families who trusted those banks saw their entire life savings, their whole future, just vanish. Poof, gone, overnight. Public trust wasn't just damaged, it was completely and utterly shattered. This question was on everyone's lips, all across America. There was this profound sense of betrayal. Can you imagine? People had placed their faith, their life's work into these institutions only to be left with absolutely nothing. That public outrage created this undeniable, powerful demand for change. Something had to be done to make sure this could never, ever happen again. And that demand for change, well, it set the stage for one of the biggest reforms in American financial history. It was finally time to draw a clear line in the sand. So, in 1933, Franklin D. Roosevelt takes office right in the middle of the Great Depression, and he had a crystal-clear mandate from the American people: fix this broken system. He knew you couldn't rebuild faith in the economy with just speeches. It was going to take bold, decisive action and, most importantly, brand new laws. The big solution came in the form of the Banking Act of 1933, which we all know better as the Glass-Steagall Act. It was named after its sponsors, Senator Carter Glass and Representative Henry Steagall, and its goal was simple, but at the time, totally revolutionary: to completely restructure the entire banking system. So what the act did was create this brilliant firewall. On one side, you've got commercial banks. Think Main Street banks. They take your deposits, they make loans. Simple. On the other side, you have investment banks. Think Wall Street. They trade stocks and securities. The law basically said you can be one or the other, but you cannot be both. Your savings could no longer be used as poker chips in Wall Street's casino. Now, as you can probably guess, Wall Street did not like this one bit. The financial industry launched this massive campaign against the bill. They were screaming that it was too radical, that it would crush economic growth and destroy the engine of the American economy. The lobbying was absolutely fierce. But here's the thing. The voices of all those lobbyists were completely drowned out by the roar of the public. Having just lost everything, Americans had zero interest in hearing arguments about industry profits. They wanted safety. They wanted a guarantee. And they demanded that their government step up and provide it. And the will of the people won. The law was passed, and its impact was immediate and profound. It kicked off a whole new era of financial stability. The act did two really critical things. First, it built that firewall we just talked about. Second, it created something we all just take for granted now, the Federal Deposit Insurance Corporation, the FDIC. For the very first time, the government itself insured your bank deposits. This was a total game changer. All of a sudden, people knew their money was safe, and that confidence in the whole banking system slowly but surely started to come back. And what was the result? For the next 66 years, the American financial system saw this period of incredible stability. The kind of widespread bank failures that defined the Great Depression, they just didn't happen. That firewall held strong, and it proved just how effective it was decade after decade.
For more than 6 decades, the law did exactly what it was supposed to do. It kept routine, everyday banking separate from risky speculation, and that protected the entire economy from Wall Street getting carried away. People often look back on this time as a golden era of safe, reliable, and maybe even a little bit boring banking. And when it's your life savings, boring is good. But, of course, the story doesn't end there. The legacy of this act is really complex, and it continues to echo in all of our financial debates, even today.
So in 1999, after years and years of lobbying, the core parts of the Glass-Steagall Act were repealed. The firewall was torn down. Banks could once again merge their commercial and investment businesses, creating these massive, too-big-to-fail giants. And then what happened? Less than a decade later, the world was plunged into the 2008 global financial crisis, a crisis sparked by risky behavior at these exact same massive financial institutions. The parallels to the 1920s were pretty hard to ignore. When you look at the whole picture, the story of Glass-Steagall really is a powerful lesson. It stands as one of the most important financial reforms in history. It's like a testament to the idea that when a government acts decisively, it really can create rules that shield the public from the risks that come with powerful financial markets. And all of that leaves us with a pretty critical question for our own time, doesn't it? In today's incredibly complex, fast-moving global economy, do we still have the political will to create those kinds of strong firewalls? Can we and should we build laws to protect ordinary people from the immense power of modern markets?